Welcome, everyone. Another episode of Financial 15. We're going back to our Becker Orr original series, How to Fund Your Retirement. We've had a couple of episodes already. This one, we're talking about investment income. Absolutely going to talk about dividends. We're also going to look at interest, capital gains, lots of good information. You definitely want to stick around.
Yes, every year tax season gets upon us, and we always have to worry about what kind of T-slips we get, dividend, interest, income. These are all important steps as to how you can deal with what kind of an income stream you're getting for funding your retirement. And remember, if you want to find videos on this or anything else in that vein, please go to our YouTube channel and subscribe. Lots of information there, lots of great content. We can help out with a lot of different questions as well. If not, please like us on Facebook. And most importantly, visit our website at beckerorr.com. We carry lots of blogs and everything else along those lines, just to make sure that you're getting the right necessary information that you need. But today, as Clint said, our original series, How to Fund Your Retirement, we're dealing with investment income and how that affects you going forward for funding your retirement. Clint, I think before we go anywhere else, shouldn't we start with what is investment income and what kind of things are we talking about? And what part of this are we dealing with?
Absolutely. So we're going through the whole series of how do you get your funding in retirement? Where does the money come from? So a reminder, we talked about this last time. We'll talk about it again. It's the sources of retirement income. You can see the little colorful blocks there. You might get some from your employer. Maybe you got a pension there. You got the government pension, CPP, OAS. We have a whole video on that. And then the personal block there is your personal savings. That's where we're diving into today. Your personal investments, dividend income versus interest income, capital gains. How does it all come together? That's part of the personal savings. And key here, Kevin, is the yellow at the bottom, right? You need to know your target. What are you working towards?
Yeah, having the budget's the big thing. We always want to make sure that that's the one thing you want in place, because everybody assumes that, well, right now while you're working, you have a steady income and there's money coming in and there's always done. Once you hit retirement, that steady income's not there anymore. So you really have to figure out exactly how much you're spending on a monthly basis so that you can plan for how am I going to draw my money out? Am I earning interest that I need to? Am I drawing money from my RSPs? Is it principal that I'm taking? Lots of different things. So the budget, again, is important. I know a lot of people don't like doing that, but it's a necessary evil that we have to do all the time just to make sure we can survive the way we want.
It's required. Now, diving into that personal savings, that purple block, we're looking at the investments, and there's four main types of investment income. We're going to go through them. You have your interest income, you have your capital gains, your dividends, your return of capital. That's the four right there. And there's some different attributes to all of them. So I'll pull this up here, Kevin, and you can walk us through some of those four types of investment income.
Yeah, I mean, basically, each type of investment income has a different scenario, and it'll apply to what account you've got it put into. But why don't we just start by defining some of these things? Interest income is basically if you have a bond, if you have a mortgage fund, if you have a GIC, anything that's earned off of those is pure interest. That is fully taxable and treated as income. So again, on our example that we've got here, if you're earning $1,000, you're taxed, assuming that you're making, let's say, $90,000 a year, $1,000 worth of income, you're going to be taxed at 37.9%, so $379 in tax. Dividends is another one that we deal with. Again, dividends usually come from equities. You could get it from stocks that are paying, from preferred shares that are paying. Now, again, you are taxed on it, but since this is money that has already been taxed at the corporation level, you get a dividend tax credit to apply. So the tax credit, dividend amount, the gross up, and then the credits applied. So on that scenario, you're looking at 20.53% on our example for $1,000 or $205. Clint, what do capital gains deal with?
Yeah, so capital gains, again, you're looking at equities, you're looking at stocks. You buy shares of Royal Bank, for example, you pay $100, it goes up to $110. Well, that's a capital gain, that $10 difference. Now, it's taxed quite efficiently. So half of it is tax-free. The other half is added to your income. So essentially, it's half the normal tax rate. So if you look at that tax column on $1,000, you can see the top one, interest income, $379. And essentially, capital gains is half of that at $189.50. And again, we're looking at Manitoba rates for 2022, and assuming you have 90,000 of income, that's how these tax examples are calculated. But the same theory would apply regardless where you live in Canada. The idea that interest income, the most taxed, dividends quite efficient, capital gains the least tax, and then return of capital. Though that does exist, that does happen. Real estate is a key example where someone would probably have a return of capital distribution. Essentially, it's some of your own money coming back to you, so you don't pay any tax when you get it. So there's no tax there. It does lower your cost base. So down the road, when you sell the investment, you could have a capital gain, but you pay that down the road. So you get nothing today, and then down the road, you end up with a capital gain. So return of capital is a very efficient source of investment income. So we know the four sources. We kind of see the hierarchy in terms of taxation there, Kevin, but this doesn't apply to everyone, right? It depends on where you put it in your investment accounts. RSPs, TFSAs, non-registered accounts, it's going to be impacted depending on the type of account, right?
Yeah, it sure is. And I mean, that's the basic scenario. Having what the different types of income that you're getting are one thing, but where they are put into an account is going to be a huge factor. So if we take a look basically to start with at all registered accounts, RSPs, RIFs, LIRAs, LIFs, basically what you're finding is that anything that's earned in there doesn't matter because all payments that come out of these factors when you draw is taxed as income. So if you're earning dividends or if you're earning return of capital and you're getting those distributions, it won't make a difference. You don't get a tax break on it at all. It all comes out as pure income because this is money that has been sheltered and never taxed. So that's why the government's going to tax it as income. TFSAs, exactly the same way. It is basically listed as a registered account, but this time all the payments come out to you tax-free because it was always non-registered cash that went in. So there was no tax break up front. The TFSA didn't give you that, but it gives you the tax break on the end. So all the payments that you get, again, doesn't matter what type of income you're earning off of it, it all comes out tax-free. And then we deal with the non-registered side, Clint. Why don't you walk us through that?
Yeah, that's what we just talked about, the non-registered investments. So if you have a stock inside of a non-registered account, well, then you might be getting the dividend and paying that dividend tax credit or having that dividend tax credit, so you pay a little less tax, or interest income or capital gain. That's where those would apply. It would only really be in the non-registered account. So if you have a dividend inside your TFSA, well, that's great. Maybe you'll make a little more money, but tax situation is going to be the same. It's all tax-free. And then the opposite in the RSP, it's all taxable regardless of the type of source. So we're looking at how to fund the retirement. We're saying, all right, these different sources of income, which is great. You need to generate income from your investments, but where it is put in the different account will matter. So if it's in the RSP, anything comes out fully taxable. So whether you have dividends, interest, won't make as big of a difference for taxable income. It's really that non-registered account that applies. So it kind of leads to the decision or leads to the question, Kevin, is all right, well, what investment should I put where? And that kind of is the idea of asset location, is how to arrange it. So you get that dividend income, you get that interest income, but you get it more tax efficiently, right?
Yeah, and again, these are not hard and fast rules, but the basics that you'd want to take a look at is anywhere where you're earning income interest, such as a bond or a mortgage fund or a GIC that's fully taxable, you want to put those in tax-deferred accounts. And the rationale is because normally you're taxed 100% on it. So if you're going to be taxed 100% on it, you want to make sure that you can collect as much of this stuff before you have to draw out. So an RSP is a perfect example of where to put one of those things. Or if it's in a RIF or a LIRA, that's one area to go. If you're looking at the dividends, well, dividend tax credit only applies if it's in a non-registered account. So again, if it's inside of a tax-free savings account or an RSP, you're not getting the tax break that you're going to get for the dividend tax credit, because in one, it all comes out free, and the other one, it all comes out as income. So that's the scenario, putting it in a non-registered. Capital gains, again, the 50% inclusion rate, equities, non-registered, and return of capital tends to be the same. So as we can see, theoretically, anything that earns interest income should be in a tax-deferred account, and anything that's earning a dividend tax credit, a capital gain, or a return of capital should probably be in a non-registered. But these aren't hard and fast rules, are they, Clint?
No. The idea there is just that there's some of those investments, the dividends, capital gain, return of capital, they have some tax perks, but you can only take advantage of those tax perks if it's in a non-registered account. So that's the idea there. And important, you can see it on the bottom there, that tax should not be your primary consideration when you do an investment, specifically with retirement planning. There's other things that come to mind. You have to make sure the portfolio is going to be meeting your goals. You're comfortable with the level of risk. We haven't even talked about risk, but the investments that generate these various types of income have different levels of risk, usually. So you have to make sure you're comfortable with the risk. The portfolio is actually meeting your goals. Taxation should be lower on that priority list. This is just letting you know that, all right, if we're trying to fund our retirement, we have different sources of income within our portfolio. How are they all taxed? And then a couple of final points here, Kevin. I think we've already kind of hit this one, but as you just talked about, it's really the asset location, the different types of income. It's really for non-registered accounts where this applies.
Yeah, it is. I mean, that's the biggest factor. I mean, you're looking at, if it's a really small non-registered account, it may or may not have a big bearing, but the larger your non-registered money is, the more that's going to play into it. You're going to want some form of a tax break if you can get it, depending on your risk levels. And that's where it really matters. So yeah, making sure that your non-registered is looked after for the best tax efficient way. Again, assuming your risk factors and what your goals are.
Exactly. Which kind of comes to having a plan. You need to be able to put it all
Mhm.
together. So yes, this is one way you can fund your retirement through your personal investments. There's going to be different sources of income there depending on the type of investment, but you have to make sure it all kind of flows together and it matches your overall goals. And that's where a plan comes in handy, right? That's how
Yes.
you kind of pull it together. That's how you make sure all your objectives actually get accomplished. We did that quickly, but of course, if you have questions, we're happy to help out. Where do you want people to go if they have questions?
I want people to go to chatwithclintonandkevin.com. We have more than enough answers that we hopefully can give to you on each topic that we've talked about. But again, if you want more in-depth involvement, we've done this at more of a high level. We wanted to give the big stressing for you on what these things are. We can dive into your personal situation as well. Other than that, I think that's another area that we've covered now. There is more to how to fund your retirement that we will be coming up with in the next couple of weeks. So make sure that you tune in and watch, and also subscribe to our YouTube channel. And a lot of these videos, we do have pieces that we've talked about in other videos from there. Other than that, I have nothing else left to say. Final words are yours, Clint.
I think we covered it all. So back again soon with another video. Take care.